This is Chuck Trice, and today we're going to talk about some pretty interesting things, and that is the financial calculator and how to determine payments, balloon payments, interest rates, yields, and all the things that you use in your brokerage every day. Now, I think every broker and every investor should know at least how to calculate these payments and how to calculate your balloons and your payoffs, and just how to determine if you can afford a property or not. Probably one of the biggest questions that you always get asked in a real estate deal is, what is the payment? How much will I owe in 5 years? Now, if you can't tell them that, that kind of looks bad. You should be able to tell investors what their payment would be if they get a certain type of loan. You should be able to tell them if they're going to hold the loan for 5 years, what the payoff will be if all the payments are made on time. So these are just the answers to basic questions that all investors ask. So let's get right into it and see how this works. Now, I'm not an attorney and I'm not a CPA. I just have many years' experience in doing this kind of work. And so today we'll talk about some of those things that I have learned. Now, the real estate education that you can get through the CCIM is really good, and also the National Council of Exchangers. When we meet 4 times a year, we have one whole day of education, so you really get the good education exactly on how to function in the commercial investment real estate world. Today we're going to talk about interest rate versus yield. So interest is the cost of funds. That's all it is. You're renting the money. Interest is the face rate on the note, and that's what you hope to get, or that's what you pay. Now, yield is a little bit different. I mean, it's a rate, but it takes into account fees and commissions and the time value of the money. A good explanation of the time value of money is that money today is worth more than the money you'll get next month or next year. So the yield takes into account the risk, the points, the title search, the legal fees, the servicing fees, the late payments, the missed payments, and yield can only be calculated in arrears. It's after the fact. Now, interest is what you are paying to use the funds. I like to say you're renting the money, and the person that is loaning you the money, the bank or the institution or the private financing, they are collecting fees and rent on their money, and that rent is the base rate on the note. So how is that calculated? A lot of times I see deals that are interest only, short term, usually for a year, 2 or 3 years, and that's short-term money, they call it. And it's calculated in several ways: daily, monthly, quarterly, semi-annually, annually. And so interest is just the principal amount of the loan times the rate. If the rate's 8%, it's times 8% divided by 12. So it's pretty easy just to calculate interest only. But interest is calculated on the remaining principal balance. And of course, that loan that you get, it could be interest only, or it could be amortized over a certain term. And probably the biggest term that you see is 30 years. You go beyond 30 years and it don't make any difference at all. Now, these are the 2 calculators I use the most. The HP12C, I used to carry it with me all the time, but I use the 10B2 as you see on the right, and that calculator is on my phone, and it's called All in a Day. All in a Day is the name of that software program, and it's really a good program to use on your phone. Now, here's an interesting formula that I'd like to share with you. You'll hear this a lot of times in the meetings that I attend. The 10 for 12 formula is you contract for 12 payments, but you only pay for 10 payments. And when you do that, it will give you a yield. And interesting to know that that yield is always 35%. And so it sounds kind of simple that, hey, I'll buy your note. I'll buy 12 payments, but I'll only pay you for 10. That sounds pretty good. Why, the discount's only 2 payments. That's not bad at all. So you'll say, sure, I will sell you 12 payments and you pay me back for 10. And that will always come out to be 35%. So let's look at the calculator just a little bit and see how that looks. There. So here's my calculator. Now this is live, and this is a screencast of my calculator, and this is the 10B2 that I'm using. It's right on my phone, and it's the same thing you see on the screen there. So as you can see across the top, there's N, I divided by YR, PV, payment, and future value. Now these are only the 5 keys that you need to know anything about. I mean, these are the keys that you would use to figure the payment on a note, to discount a note, to buy a partial, to figure your payment over, to figure your balloons. There's only 5 keys that you need to remember. You can put these variables in any order that you want, and you only need 3 of them, and you can figure the 4th. And so remember, if you put in 3, you can solve for the 4th. You might want to solve for the payment, the present value, or principal value, the interest rate per year, or the term. One of these figures, like present value or payment, one of those two always have to be a negative. Otherwise, you'll get a false reading on the calculator, and you'll know it when you see it. But one of those has to be a negative. Now, if you're a lender and you're putting out $200,000, then that's a negative for you because that's money going out. If you're a buyer, then the payment is negative to you because that's money going out. So either one of those need to be a negative. Not both of them, just one of them. And also, I have the calculator set to 12 payments per year. The interest per year, you just put that in as a whole number. You don't have to divide it by 12 or anything like that. You don't have to use a decimal. You just put it in as a whole number, and it will calculate it because it's set to 12 payments per year. Now you can set the calculator for yearly payments, semi-annual. You can set it for monthly payments, quarterly payments, and so then the calculator will do the rest. So let's clear the calculator and see how this works. Now, you can just clear the register out like I'm going to do right now, and I just hit C. You saw that blink, and that just clears the calculator. Now, if you use the gold key, that will clear everything out of the registers. There won't be anything there. Right now, I think I can recall the PV, and that's what was in the calculator previously. So it just cleared the screen. It didn't clear the memory. So if you use Shift C, then that clears everything, and now there's nothing in the calculator. So let's just pick a payment. I don't know what payment. Let's just pick $200,000. Now remember, I said that one of these has to be a negative, so I'm going to change that to negative. So we got a negative $200,000, hit PV, principal amount. And now, how long is this going to be for? Well, let's say that this is a 30-year payment. You can do that in your head. You know that 30 times 12 is 360 months. So let's put 360 in. Now, you could go 30, gold key, shift, and then put that in N. And that also, because the calculator would take the 30 and multiply it times 12, because your calculator is set to 12 payments per year. So either way, you can do it. Now, what about the interest rate? Well, you say, I'm going to charge 6%. That's a pretty good going rate. So you don't have to do anything. Just hit 6. Remember, a whole number. Put IR. Now it's in the calculator. So now we've got 3 of those variables in. We've got the principal value amount. We've got the interest rate per year, and we've got the term. So now we want to know what the payment is, so you just hit payment. So the payment's $1,199.10. Now, here is where you really need to practice on the calculator and get used to this, because you'll get these questions. The buyer will say, I can't afford $1,200 a month. About all I can afford would be $975 a month. Now, what would you do with that? Well, we just hit $975 and hit payment. And now we got to either solve for an interest rate or a term or a present value. So let's just hit PV. So you could afford $162,621. So if your house was, say, $200,000, you'd have to come up with about $38,000 to be able to afford this house at a $975 a month house payment. Now let's recall the payment. You see it's $975. Recall the present value, $162. Recall the interest per year is 6, and recall the term is 360 months. And so you can see how you can move these figures around. Let's say, well, the buyer says, I don't want to go out 30 years. That's a long time. Let's go out 20. So 20 times 12 is 240. So I'll just put 240 in, and we'll solve for, let's solve for present value. So that goes down to $136,000, but you reduce the term to 20 years instead of 30. But you didn't change the payment. So you can see how you can move all of these variables around and solve for the one that you want. Now, let's say that right now we haven't done anything with the future value. So let's say, well, a $136,000 mortgage, payment's $975 a month. What would we owe in 5 years? So future value, we haven't used that yet, so let's just put 5 years in. 5 years is 60 months, so 60 in, future value, you would owe $115,540.92. And that's the beauty of this calculator is if you ask me how much is my payment, I can tell you. If you've been making payments for 10 years and you say, a lot of people, they say, well, 10 years, I must not owe very much because, boy, I've been making these payments every month for 10 years. And so for 10 years, 120 months, I can calculate that balloon payment or that payoff amount in just a quick few keystrokes. And so that's the beauty of it. And another thing is people are not quite tuned in to the time value of money. As your principal balance starts out, say, $136,000 as we had, then most all of that payment is going toward principal for at least the first 10 to 12, 15 years before you start seeing any big reduction in the amount of the principal. And so it is quite a shock when people say, I've been paying for 10 years and I still owe that amount of money. How can that be? And so we'll just have to try to discuss the time value of money and how that works. Now you can see this on my screen. It's called T-Value Online. And let me unlock it. T-Value Online. Now, I can change anything on here, and let's just work it for a little bit, and I hope you can see that these things changed. I'm going to go File, New, and I don't want to save that one. And now, here's what it says. The loan is like 1223.22. I'm going to start it at 1-1-2023. And so there we've started our payment on January the 1st, this coming year. Let's say that this is going to be for $200,000. One loan, that's what the number one is, for $200,000. Hit enter. And now we go down to the payment. So usually more amortization is 30 days later. You'll owe a payment of principal and interest. Interest is always figured in arrears on a mortgage. And so, because you're renting that money for a month, and at the end of the month, you got to pay the rent on that money, which is the face rate of the note. So let's see what that is. And so we don't know what the payment is, but we know what the annual rate is. The annual rate, we're going to say, is 6%. So I'll put that in. But now we've got the payment down here waiting, and we don't know what it is. So the way this software works is you put unknown. So I don't know what the payment is right now. It's a 30-year payment, and we're going to say line 2, it's unknown, but we know that we have 360 of those payments. So now all I have to do, remember I've got $200,000 in there, I've got the term of the loan in there, and I've got the interest rate in. And so now solve for the fourth, which will be the payment, all we have to do is just hit calculate. And there it is, $1,199.10. That quick. Now let's say, well, I don't like that rate. What if we went down to 3.5? Let me highlight that and say 3.5. And then we hit calculate. So the payment is $808.09. So you can tell exactly the cost of funds. We went from 6% to 3.5%, and we dropped our payment, about $300, nearly $400 a month. So that is how you do it. You can change the rate, you can change the loan amount, you can change the payment, you can change the term. And now let's go over and let's look at the amortization schedule, and I'll show you what that looks like. There's the amortization schedule. You can see that it's monthly, it's 3.5%, gives you a periodic rate, a daily rate, and the loan amount. And you can see down here in the payments, where the payment's $808 or $898, the interest is $583. So you can see that's pretty healthy, and you're only dropping the principal by $314. So let's look at 5 years. There's would be 60 months. We talked about paying this off. What would I owe in 60 months? Now in 60 months, you can see that you still owe $179,394. You have not dropped the principal by very much because you still owe $179,000, and you started out with $200,000. So that's what, nearly $20,000 that you have paid off in 5 years. And that's why it's always been taught to us in the real estate business, if you can make extra payments, then you should. Like maybe instead of making 12 payments a year, you make 15 payments a year. In other words, you make your payment of principal and interest, and then you say, okay, here's another $200 that I want to drop the principal by. And that way you'll pay it off quicker and easier. So you can do that, because the key is to reduce the principal so that you're not paying so much to rent that money. And so I like T-Value Online very much, because I can figure all of these payments and just see how and I can show this to the client, and the client loves it because they can see what they will owe for the whole term. Now let's go down here at the bottom, and it will give you other information. Your annual percentage rate is 3.5%. Your finance charge cost you $123,000. The total amount financed, instead of come to $200,000, but the total payments come up to $323,000. So you can see that probably it would be a good idea, if you can, to make principal payments and reduce that principal so you're not paying so much on interest. So the grand total's $323,000. But this is the T-Value Online amortization software, and it's a really good piece of software to have, and it only costs about $65 a year, and I use it all the time. Let's look at an example, and let's turn my calculator back on. So let's see, now I just did a flip of the screen. You can see down in the bottom right-hand corner of my screen it says 10B2, so let's go 10B2, F clear, and that clears my calculator. Nothing on the screen there. So let's say we've got a building that's $1,500,000 in value. Now, the owner has agreed to carry back a note at $1,200,000 at 6% for 30 years. So what that means is that you have put down $300,000 on that building, and you're going to carry back $1,200,000. So let's put this in the calculator and see how it works. And there's a balloon in 5 years, so $1,200,000. And remember, change that to a negative and hit PV. All right, now we got 6%, put that in as a whole number. 30 years, we can go 30 shift in 360 months. Now we've got 3 of those variables in, we just need to ask for the 4th, and the payment is $7,194.60. So that's how you do the payment, that quick. Somebody says, well, $1,200,000 note, what's my payment going to be? Well, what will I owe in 5 years? Because maybe the owner says, hey, I will finance it for about 5 years, but I would like to be paid off because really I want the money. And so let's see, 60 months is 5 years, put that in N, and now let's solve for the future value. So in 5 years, the person that bought your building is paying on the note, still owes $1,116,652. So that is how quickly that you can calculate the payment, the rate, or anything like that. Now let's go back up and put $1,200,000 back in the calculator, PV, and we're going to put 30FN back in and solve for the payment. Whoops, I better put 0 in future value because that would calculate into the balloon payment. We don't want that. And now we're going to ask for the payment, $7,194. You see, I just made a mistake, forgot to clear the future value out. Well, you don't have to change everything in the calculator. All you have to do is go put a 0 in that variable, and that will clear it out. Now, my calculator come out with the same payment. Let's go to the next one. Let me move this calculator over just a little bit to right there. I really like this program. I'm using a program called Reflector 4, and Reflector 4 allows me to capture my cell phone or any other, my tablet, and cast it up onto the screen. And while I'm making this video. So now we've got I'll make a chart like this, and if you make a chart like this will help you a lot, because 360 is the term, interest per year is 6%, $1,200,000, the payment's $7,194.60. Now, let's say that you're holding this note at $1,200,000, and you don't want to hold the note. You don't want monthly payments. You say, well, I would like to sell this note. So what would an investor pay for this note? Well, I'll tell you, most investors will say, for a building that size and this large amount of money, if that building went vacant, it would take 6 months or a year maybe to lease it in some markets. And so that would be quite a risk for me, and I've got $1,200,000 out there potentially, and so that's quite a risk. So most investors will not pay you the face value of the note. They want a discount to take care of that risk. Now, one interesting thing is you can go buy a piece of property with the note and not have to discount the note. That sounds pretty good, right? Because usually, if you take a discount on the note, that's a reduction in the price. And most buyers or sellers know that they're going to drop the price on their property so they can get the property sold. But we're talking about notes, and the notes are calculated based on the amount of risk that the investor thinks their money is subject to. So let's say the investor does not like 6%, but the investor says, well, I want 8%. My target yield, remember yield is figured after the fact, my target yield is 8%. So I will buy your note, but I want an 8% yield. So let's just put 8 in the calculator, and we'll solve for the present value. Now, if you see on the screen and you see on the calculator, it's $980,506. Now, I've already figured this. That equates to an 18% discount. So you have to ask yourself, if you're the previous owner of the building, would you have taken an 18% discount on the price of your building? A lot of times that is yes. And so that's how it works, the same with notes. Now let's say this same investor looks at this building and says, wow, boy, that's such a big building. I think it's going to be hard to lease. If the guy that's in there now has to file bankruptcy or it goes into foreclosure for any reason whatsoever, and I'm stuck with those not getting that $7,000 a month, I would be in bad shape. So my risk rate is 10%. So we don't have to clear the calculator, don't have to do anything. Just remember, we changed the variable. So let's go 10i, and we ask for the present value. Well, it says $819,831. Now that's quite a discount. But believe it or not, depending on the market, depending on the location, depending on the quality of the building, you might take a 42% discount on that note if you were to sell it. And that's what all investors look at, whether they do it consciously or subconsciously. You look at what you think the risk is, and you make your offer based on that. So 42% discount. If a broker came to you with a contract and said, I've got a buyer for your building, but they want a 42% discount, you probably would not take it. But when you're selling a note, then the investor that's investing the money to buy the payments on that note is going to look at the risk of them getting their funds and not losing their money, and that risk to them, only them, may be 42%. So that's how you use the calculator to calculate potential yields after the fact, or you see what you would pay for the right to receive 360 payments. So let's look at this a little bit different. Let's go back and put our calculator back like it was. Now I don't have to clear all the figures. I just say 1,200,000. Change the sign, present value. So now I'm going to put 6% back in the rate, and I'm going to put 30 back in there in the term, and then solve for the payment. $7,194.60. Now let's say that the buyer that bought the building, and now they're going to start paying on the note. They say, well, I'm going to pay you off in 5 years. Perhaps the seller says, I'll carry you for a while, but I want to be paid off in 5 years. So how are we going to figure that? How do you figure that? You don't have to do anything with the calculator except 60 is 5 years. So put that in N, and now we're going to solve for future value because it's out there in the future. Now, one interesting fact, if you can buy the payments if you want to, and that has at a certain yield, and you'll get a price for that you could pay for those payments. And you also can get a price that you would pay for that balloon. And so the time value of money really comes into play here, because if you have to wait 5 years to get your money, what would that be worth today? That's the time value of money. So let's see what it says. It says in 5 years you'll still owe $1,116,000. So that means that in 5 years the borrower is going to have to pay you off. A lot of times balloons don't get paid off just because it's hard to get the funds when you think you need the funds. But if they can pay you off, then you'll get $1,116,652. But a lot of times a note will just be extended. You could extend the note. You could say, hey, I'll finance you for another 5 years if you'll pay down the note by $50,000. Or, Mr. Borrower, I will finance you for another 5 years, but I want to raise the rate from 6% to 8%. You can do a lot of things with the note: raise the interest rate, drop the interest rate, extend the term, ask for more money down, and then solve for a new balance and continue on for another 5 years. So that's how I think that you should use the calculator and learn how to use these 5 figures or 5 variables across the top, and you can answer about any question that a buyer or a borrower or a note investor would have. So thanks for watching this video, and get that 10B2 calculator on your phone, and the name of that software is called All in a Day, and it's a great piece of software, and it goes really good on your phone, and I've used it for years. So thanks for watching.